name is Bill Neville. I'm with the Entrust Group, and we're doing kind of a special webinar today. Is for those of you who are regulars or know, we have a monthly webinar, a monthly educational webinar, typically the second Wednesday of every month. Occasionally, it's the third Wednesday of every month, depending upon schedules of the presenter. But Neal has a topic that he felt was timely, we feel is timely, and so instead of waiting for the next availability of the monthly, the standard monthly webinar that we do, we kind of squeezed this one in so that we could get this information out to you on the most timely fashion. So anybody who has attended one of our webinars where Neal was the speaker, you know what you're in for. You're going to get a lot of data-driven information. It's going to be entertaining. It's going to be interesting. It's going to be educational. And as always, at the end of the presentation, Neal and I will answer any questions that you have. Feel free to pop the questions in at any time throughout the webinar, but we'll cover them at the end. So this is our standard information that we put up that just states that we are not investment advisors or CPAs or attorneys. Entrust is strictly a custodian record keeper of retirement accounts. So before making investments, seek the advice of advisors, attorneys, people who have the kind of accreditation you need. I'm going to talk a little bit about Entrust and self-directed IRAs, but only for a minute. Then we're going to get into Neal's presentation, inflation. I was going to read those, but that's all right. We'll just skip to it.
Here we go.
Yeah, inflation, interest rates, and the Fed's gambit. Is the U.S. housing in a boom or a bubble? And some projections for the future, and then again Q&A at the end. The next screen is just a little bit about me. Go ahead. I'm not that important at this moment. Go ahead to the next one. A little bit about Entrust. We've been in business for over 40 years. We provide a single point of contact. We have about $4 billion in assets, and we have over our history had about 45,000 investors who used Entrust. We currently hold about 22,000 account holders. We are administrators and custodians of self-directed retirement accounts. Those are retirement accounts in which you make all your own investment decisions and you can hold non-traditional assets. We're headquartered in Oakland, California, but we do have offices throughout the United States. What is a self-directed IRA? I just mentioned that. It is a retirement account in which the custodian that you have the accounts, we're a self-directed custodian, does not give any advice, does not sell you any investments. However, you're not limited to just stocks, bonds, and mutual funds. You can invest in other alternative assets like real estate, precious metals, private placements, promissory notes, tax liens, trust deeds, et cetera, et cetera. I could go on and on. Go ahead, Neal. And that's it for me. Neal, I'm going to let you take over. I'm going to go on mute, and then I'll pop back on whenever we get to the Q&A time.
Sounds good. Thank you, Bill. Thanks so much for this opportunity. Welcome, everyone, to this research and data-driven webinar on how Jerome Powell, that's the guy on the screen, and his merry band of Fed governors are affecting everything in the economy and everything in real estate with these aggressive rate increases. Today, you're going to learn that the Fed is gut punching the US economy and why that is the right thing to do. And this gut punch, it affects everything: prices and sales volume, single family, multifamily, cap rates, mortgage rates, inflation, everything in the economy. So this webinar is going to touch on all of those aspects. Throughout the webinar, I'm going to present data from dozens of different sources about how the interest rate and inflation are affecting real estate every day in so many different ways. And at the end, I'm going to stick my neck out. I'm going to make a 12-month prediction on prices and rates, and I'm going to point out all the areas where I disagree with the experts. I do obsess over these predictions because many of you will screenshot that last night and throw it in my face a year from now. But hey, thanks for doing that, because it makes me a more careful forecaster for this kind of product. For those of you who don't know me, I am a quirky and opinionated data scientist and technologist who buys and builds large real estate projects, multifamily, student housing, industrial, self-storage. These are all favorite watering holes of mine. And our portfolio of 30 properties in 10 states is worth nearly $1 billion, but that's my day job. What I like most is to present, to explode myths, and that's what I'm going to be doing today, and I hope you have as much fun with it as I am going to have. So why am I qualified to do a webinar on interest rates? Well, this is a sampling of my portfolio. This part's about 400 million, and I worry about the impact of interest rates on the cash flow and sale prices of those projects every day. Every day I think about how to minimize that impact, and I think that's qualification enough. Now on the left in green are past and present multifamily value adds. We've been exiting them at high returns. And in orange on the top right are new construction apartment complexes that we're building or have built. In blue are diversification projects that our investors wanted, like self-storage and industrial warehouses. And what the Fed is doing is affecting all of these. And so I obsess about it. And so I might as well talk about it since I'm obsessing about it. We also have something known as build to rent, which is the newest asset class in multifamily. If you don't know build to rent today, it's the same as not knowing Bitcoin in 2010. Simply put, BTR is the new Class A apartment complex. This is the largest, the most powerful, and in my opinion, the most profitable opportunity that exists in real estate today. Here's our track record. We're not allowed to show you any information about any kind of project, but the ones that have exited in the past, we can share this information. This is our track record for projects that we have exited in the past. Remember, past performance is not a necessary indicator of future performance. Now, track record is critical, but what's more important to us is that our 800 investors really like us. They like our work. For example, Sarah, she's invested in 8 deals. She's had 3 terrific exits. She's also invested in new construction projects that are expected now to outperform. And on the screen, she talks about how we outperform other syndicates and how we look for better ways to do things. So take a look. All right, let's get started. Look at this. My design team really knows how to get their message across. 8.5% in a country where the average inflation has been under 2%. I filled gas in my car yesterday, and a $100 bill didn't fill up my 16-gallon tank. Section 1 of this presentation talks about runaway inflation, interest rates, and the Fed's very dangerous gambit. So get ready for some powerful data. Now, we're going to start this journey by looking at mortgage rates first. Let's start with this CNBC video. It's from a month ago. Before I play the video, remember, the Federal Reserve does not set mortgage rates. They only influence them. So give me a second and I'll pop up the video. And here it comes.
Hey, Morgan. Yeah, rates took a sizable jump higher at the end of last week, basically adding insult to injury in the heart of the spring market. The average on the 30-year fixed hit 5.64% on Friday. That's just over 2.5 full percentage points higher than a year ago, as in we were in the very low 3% range last year. Mortgage rates loosely follow the yield on the 10-year Treasury, which spiked to over 3%. But rates are also taking a hit from the Fed unloading its balance sheet of mortgage-backed bonds. It was the Fed's increased purchasing of those bonds during the first 2 years of the pandemic that kept rates hitting more than a dozen record low. And those low rates fueled the crazy high home prices that we now have this spring. Home prices are 34% higher than the start of the pandemic, and they just keep moving up due to high demand and still low supply. So if the 30-year fixed hits 5.75%, which it very well could this week, that'll mean the monthly mortgage payment for the average home is $1,867 higher than it was at the start of the pandemic, $1,867. That's if you're putting 20% down. It would be over $2,000 more a month if you can only put 10% down, which is a lot of first-time buyers using FHA mortgages, and they, of course, have the least wiggle room in their wallets. We're now seeing sales fall and reports anecdotally that bidding wars are starting to cool off. Prices usually lag sales by about 6 months, so this summer should be pretty telling on home prices, Morgan.
All right, let's get back to the presentation. Very interesting commentary there. I think you'll agree with me. Let me get back to my screen. So let's summarize this video that you just watched, right? Mortgage rates in May were about 5.64%. See where my mouse is? For 30-year fixed, this morning I checked and they are the same at 5.63% average for 30-year fixed. And this means that they are more than 1.5% higher than a year ago. And we also saw that home prices are 34% higher than before the end of the pandemic. So this means that the average monthly payment is over $1,800 a month higher than it was at the start of the pandemic. Are you kidding me? $1,800 a month? That's $22,000 a year. What regular Joe American got a $22,000 raise in only 2 years? Nobody. So that's the bad news. And I'd like to point out that the media loves to pick up the highest number to get more eyeballs. That 5.64 number on the screen is not representative of all the people watching this webinar. I sent my team out to shop rates on the internet today. And I know my investors at least can put 20% down. They've got strong credit scores. So while 5.64% may be the average mortgage rate, please note that these buyers that have higher credit scores, such as 740, and higher down payments than a typical buyer, will get significantly lower rates. So this data is from bankrate.com as of today. As you can see, the rates that are showed in the gray shaded column are in that 4.95% range for those with 20% down and 740 plus credit. Now, these numbers are for primary homes, not for investment homes. But what this means is that people with lower down payment and lower credit scores are going to get hurt more than richer investors with more buying powers who are still getting rates under 5%. So bad news for the common man, less bad for the affluent investors. So if you do put down 20 or 25% payment, you will get a better deal. Still, it's clear that mortgage rates are skyrocketing, right? A 2.5% increase in about 6 months is a stunning increase. So let's spend a few minutes to understand why rates are skyrocketing. In short, they're going up because the Federal Reserve has announced that they're going to fight inflation by raising the Fed funds rate. Let's look at where inflation is today, right? So April 2022 was 8.3, and then in May, it went up to 8.6%, right? As you can see from the red line, this red line in this graph, inflation in the US tends to average just a little bit under 2%. And the Federal Reserve's job is to keep it around that number. 2% inflation allows the US to keep overspending and running up deficits because inflation is a hidden tax. It reduces the value of money. So inflation is good for spenders, bad for savers. However, high inflation is good for no one. It's bad for consumers, bad for businesses, bad for retirees. And as you can see from this chart, inflation is far, far above that 2% line. Now, it's wrong to look at inflation statistics without acknowledging that the official measure of inflation, the CPI, or the Consumer Price Index, is inherently flawed. The numbers may be cooked, guys. The CPI is used to adjust Social Security payment for retirees, and there have been accusations for decades that the CPI is manipulated to show inflation to be lower than it actually is. So it is useful to look at an unofficial index called shadow stats, which might show a much more complete picture. Now, as you can see from this blue line above, real inflation could be as high as 12%, while the official line in red is at 8%. Bottom line, inflation is extremely high, and the Federal Reserve has no choice but to take aggressive action to reduce inflation. Let me say this again. The Fed has no choice. Now, the Fed can control inflation by raising and lowering an internal rate that they call the Fed funds rate. This rate, which is a rate that banks charge each other for their excess reserves, it has a direct impact on mortgage rates, though mortgage rates can often be out of sync with the Fed funds rate for many months. Now, in general, the Federal Reserve raises rates when inflation is high and the economy is overheating, and they drop them when the economy is weak. For example, if you look carefully at the chart, you will see that the Fed raised interest rates 9 times between 2015 and 2018. And by doing that, it slowed the economy quite a bit and then was forced to back off and drop the interest rate 3 times in 2019. What I'm pointing out is that this rate-raising business, it's more art than science. The Fed raises rates, waits for a while, studies the economy, and then drops them, waits for a while, and rinse repeat. The Fed basically plays Russian roulette with the US economy. And as you can see from this comment in The Guardian, the Fed is now expected to raise rates a total of 7 times this year. They're done with 3 hikes so far. So 4 more hikes are coming, which will mean that the Fed funds rate will go from about 0.25 at the beginning of the year to about 2.9%, according to The Guardian. So what is the Fed's goal? Well, the Fed's goal is to engineer a soft landing. More about that in a few slides. All right, so the Fed's hiked 3 times this year so far, a total of 1.5%. You can see that on the screen. But you just heard from the CNBC announcer that mortgage rates are up by almost 2.6%. So that's weird. Aren't these two rates tied to each other? Yes, but very, very loosely. What's happening is that the market is anticipating what the Fed will do in the future. So they're running roughly 1 percentage point ahead of the Fed. This is very important to understand. The market's already up 2.6%, but the Fed's only up 1.5%. The Fed has to catch up to the mortgage market. Yes, yes. But Neal, what happens when the Fed hits the 2.9% level that the economist was talking about in The Guardian a few slides ago? Well, the answer is then the Fed will start cutting rates. Yes, cutting rates. Look at this chart. Okay, the Fed controls inflation literally by gut punching the US economy. They taser us. And the country cannot take the shock of these high interest rates for more than a few months. Now look at these charts, and you will see that there are 9 hiking cycles, right? You see one right here, you see another one right here, here's another one, and then another one, and another one, right? You see these peaks, and you notice that all of the 9 peaks are extremely short. In fact, these peaks usually don't even last more than a few months. Given how addicted the economy is to financial cocaine, that's ultra low rates, and financial meth, that's ultra high liquidity, why would you expect this time to be any different? The patient, us, the economy, is going to die if it doesn't go back onto the drug grip. And the Fed knows that. Rates will peak by the end of this year or before. Inflation will hopefully moderate to, let's say, 3 or 3.5%. And then rates will fall, just like they have 9 times in the last 61 years, because the Fed is simply trying to engineer a soft landing. As you can see from the Investopedia definition, a soft landing is the Fed's goal to slow the economy down without going into a severe downturn or a recession. Choke the air from the lungs so the patient stops running around, and then resuscitate the patient before he dies. This highly technical diagram on the left accurately describes what the Fed is doing. And so, of course, a data-driven audience like this wants to know, Neal, how often has the Fed soft landed the plane? Well, as you can see from this quote from Politico, the Fed sucks at creating soft landings. In the last 61 years, the Fed has tried to engineer soft landings a total of 9 times. How many times did it succeed? Once. One time in 1994. Not the best track record. Why? Well, that's because it takes many, many months for interest rate hikes to affect the economy. So the Fed actually has to make educated guesses about the impact. In other words, the Fed cannot aim, fire, measure. It's more like aim, fire a half dozen times, then measure once. So here's another highly technical document that accurately describes what the Fed tries to do when it hikes rates. My team loves these cartoons, so that they're clearly getting carried away by these. And so that technical document explains the problem, and it also explains why the stock market is crashing. Investors feel that the Fed's job is much harder this time than most of the last 9 times because inflation is so severe. And they have very, very little trust in the Fed's ability to prevent a recession. The market is addicted to the ultra low interest rate and high liquidity punch bowl, and the Fed is taking that punch bowl away. In case you're wondering, REITs, or real estate investment trusts, are also down about the same as this S&P 500. They're down about 20%. Okay, so the Fed doesn't have a great track record, and Wall Street doesn't trust the Fed. But to be fair to the Fed, they might have a pretty decent chance of actually achieving a soft landing this time, because the Fed has one unique weapon. The Fed is tightening in an economy that is drowning in cash. Americans have absolutely fantastic household savings. As you can see from the graphic above, the total value of America's savings in both savings and money market accounts was about $12 trillion 10 years ago. In 2011, that's here on the left. Now, today that number is sitting pretty at over 22 trillion. In fact, a staggering 5.8 trillion has been added to savings account in just the last 2 years. This is incredibly good news for the Fed, because this $6 trillion buffer means that consumers are continuing to spend even as inflation goes up. They have a lot of money, and this gives the Fed a better chance of engineering that soft landing. Ta-da! Household balance sheets to the rescue. Now that I'm done with my Fed bashing, I want to point out that 5.5% interest rates, mortgage rates, may seem high, but note that people who are buying homes at an 18% interest rate right there on the screen, look at the graph. You'll see this gray area here in 1982. As you can imagine, this gray area was a recession. It was caused by the Fed raising interest rates to 18% to kill inflation. By comparison, we are now predicting the rate to go up to less than 3% at peak for the Fed funds rate, which means that mortgages should be somewhere around 6%. This is 18%. You might think that home prices would have crashed and burned. I mean, who would be stupid enough to buy a home with 18% interest, right? Wrong. When the Fed went to 18%, home prices went down by 10% the next quarter, bounced back by 10% the following quarter, and actually ended up higher at the end of the recession than at the beginning. Americans, we love buying homes, and we're not easily deterred. And that was one example. Let's take a look at another example. Here, between 2001 and 2007, rates stayed between 5 and 7.5% mortgage rates. We still had a strong housing economy. So while 5.5% seems very high, it's really nothing special at all. I also like to show this graph to investors. This graph is not updated all the way to 2022, but what I want to point out is that the mortgage rate trend in the US declined for 150 years, then went upwards, peaked in 1981, and since then, for 4 decades, they have been moving in a downward trend. And when this short-term mortgage rate spike ends, and it should end fairly quickly, I don't expect that downward trend to change. It's all tied back to macroeconomics, which I cover in my How Banking Changed the World webinar, which is available on our website, multifamilyu.com. So to summarize this section, rates are high as the Fed battles inflation. Data indicates that mortgage rates will peak well before the end of the year as mortgage rates anticipate future Fed increases. They are running ahead of the Fed. And while we do hope that the Fed engineers a soft landing, history shows this is unlikely to happen. Now that we've set the groundwork, let's go to section 2, where we discuss if the US housing boom is a bubble. And I love this graphic on the screen. Isn't that an amazing graphic? Housing in a bubble? Haha. Now, figuring out if this is a bubble is critical because we're here to try and figure out what's going to happen to real estate in the next year. And what happens depends on whether housing is indeed a bubble. So it drives all of our informed speculation. Our first data point comes from Fortune magazine and CoreLogic. As you can see above, CoreLogic believes that 65% of the US housing markets in the US are overvalued, and every major growth market, all of them, Texas, Florida, Arizona, North Carolina, Utah, all overvalued. So 2/3 of the country has overvalued real estate, and 100% of growth markets are overvalued. Okay, are you getting nervous yet? Well, you shouldn't be. Here is CoreLogic's estimate of price drops. Remember in the last slide, they were talking about overvalue, not price drops. Here you notice not much red. Blue is good. Blue is really, really good. CoreLogic estimates that 80% of the US has low or very low chances of price drops. 10% is medium. That's mostly here in purple in the Northeast. So you see some of that. And then, of course, there's some California here, right? All the growth markets, Texas, Florida, Utah, North Carolina, they're all blue except for Phoenix right here and Vegas. And the high-risk markets are in the Pacific Northwest, like Bend, Oregon, or Tacoma, Washington. Bottom line, I have poured through a number of research papers. These people all remember 2008. They're much more cautious than before. But there's a strong consensus that the market's not in a bubble. And why is it not in a bubble if it's overvalued? Why? Well, all the studies cite the lack of supply of both single family and of apartments, lack of zoned lands, supply chain constraints, rising construction costs, and a horrible NIMBY attitude towards apartments are the 4 main reasons for a lack of supply. Contrast that with 2007 when there was plenty of supply. Now match up lack of supply with very, very strong demand from boomer investors and from millennial homeowners, very strong job markets, and it's very hard for this housing bubble to burst, even if it exists. Also, as we mentioned before, the massive stimulus from COVID means that both investors and the common mans have massive amounts of accumulated savings. So if there's a dip in prices, investors will jump in. Incomes are rising very fast because of inflation. And lastly, the remote work phenomenon means that Americans are spending more on their homes. They want offices, they want more rooms. That's driving demand up even as rates moderate. Now, these are big, big reasons that lead us to the conclusion that the US single-family market is overvalued. It's not a bubble. As we looked at studies and analysis from various sources, including Forbes and the Wharton Business School, we could not find one analyst that felt that housing was a bubble that could burst. Even bearish analysts like Ivy Zelman take points to clarify that housing is overvalued but is not a bubble. On the screen are some other consistently cited reasons. First, there's these baby boomers. I mean, these people are rich. They're leveraging their equity into real estate at massive rates. They're buying single-family rentals, multifamily, single-tenant net lease retail, using 1031 exchanges, and using IRA money to prevent taxes. Secondly, the millennial generation, they've reached their peak home buying year. So from 2020 to 2024, that will be the peak. They'll be buying homes, putting upward pressure on prices. To repeat, there are big reasons that lead us to the conclusion that the US single-family market is overvalued, but it's not a bubble. And what if everybody's wrong and there's a bubble? Wouldn't interest rate hikes pop that bubble if sales tank? The answer is they probably won't because of ARMs. ARMs, adjustable rate mortgages, are back. In January, only 3% of single-family loans had an adjustable rate mortgage. But today, by May, that 3% had tripled to 9%. Currently, the average rate for a 5-year ARM is a full point lower, right? So only 4.7%. And that allows buyers to keep buying and keep that down payment down. So I wouldn't be surprised to see ARMs become 20% or even 25% of all mortgages within the next 3 months. And I know, ARMs are bad. We didn't learn from 2008, yada, yada, et cetera, et cetera. But if these ARMs are going to blow up, they're going to blow up 5 years from today. And rates don't adjust with ARMs for the next 5 years. I'm not holding my breath, and neither should you. So the US market is probably not a bubble that's going to pop. So what is actually going to happen? Well, instead of sharing information from a dozen analysts, I'm throwing up the least bullish guy. Note, everyone else thinks that the single-family market will slow down, keep growing, prices will keep going up. This dude is really the only guy that says, nah, not going up. So the most bearish guy, Mark Zandi, says the housing market has peaked. Everything points to a rolling over of the housing market. That comment in blue, it looks like doom and gloom, right? But when you jump into his detailed analysis, what he's really saying is home prices will be flat. And then look at the two green bullets. Some markets drop by 5 to 10%, and if there's a recession, then some markets drop by 10 to 20%. Still, he's talking about some markets, not the United States. And this is the most bearish analyst that I could find. I really, really hope they're not all drinking the Kool-Aid. All right, so the single-family market is probably not a bubble, just overvalued. Some of you are investors that invest in commercial, like me, like many others, multifamily, industrial, retail, all of those asset classes. Well, here's John Chang, who's a personal friend of mine. He's a national director of research at Marcus & Millichap. This video I didn't upload, so I'm not going to play it. But John's been here for 26 years at Marcus & Millichap. And his belief, which is rather technical, which is why I'm not playing it, is that while cap rates are going to go up, overall, pricing is not going to go down because rents are going completely crazy. So doesn't think that multifamily is in a bubble either. And so ends our second section. It appears that neither single family nor commercial are in a bubble, just bubbly or bubblish. So it's time for the crystal ball section. This is where I stick my neck out and basically take screenshots and use that to cut my neck off a year later. One thing about me, I never learn. So here we go again. We will make 7 predictions. 1 year from today, where will single family prices be? And multifamily, and inflation, interest rates, cap rates. We will wrap up the crystal ball section in this webinar with our predictions on the likelihood of a US recession. But before I fire up that crystal ball and finish, I want to take 2 minutes out from this content to share 2 of my current projects that really should be attractive to both active and passive investors. The first one is a unique project in the Austin market, which is the hottest market in the country. We're building a technology-enabled micro home community located in San Marcos. And we think this project is filling a sorely needed gap in the area with a severe housing crisis. We've already raised over $11 million for this project, so we're 90% subscribed. And this project, it's got 3 major elements: very efficient, modern, environmentally sensitive design. It's got an incredible tech stack of 14 different technologies that's been combined into a single mobile application, allows residents to manage their needs, control their smart home. And lastly, it's got a curated lifestyle with cultivated engagement opportunities that tenants crave. We're talking dog parks and volunteer opportunities, music events, yoga classes, and so much more. These are the Casada micro units, modular design. They're constructed off-site. This is a construction method that is incredibly popular in Europe and is broadly becoming used in the US now, allows for faster construction, less waste, higher quality, and reduces the development's initial and long-term operational cost. And obviously that means better returns, faster cash flow for investors. We think that when it comes to multifamily investing, Austin's a place to be. Let's take a quick look. In the last 10 years, the population of Austin grew by 32%. That's 5 times faster than the US, but that didn't even keep pace with a job growth of 44%. It's becoming the Silicon Valley of the US. It's got the hottest city labor market, which is why real estate prices are increasing. According to Redfin, rents went up 35% last year. Our first community in Austin started pre-leasing, and we've had to raise rents 4 times. Because of how expensive it's become to rent in Austin, residents are looking for more affordable cities, and San Marcos is the most affordable city in the Austin metro area. The rents in San Marcos, 35% cheaper, but that doesn't mean it's not experiencing growth. In the last year, rents in the city of San Marcos increased 22%, which is right on par with Austin's 23%. So cheaper rents, same growth rate. So we do highly encourage you to attend a group presentation with Andrew. He's our investor relations manager. There's a link at the bottom of the screen. You can go there and grab that link, grocapitus.com/Andrew, and we can answer all of your questions and show you information about returns and cash flow. Our second project is Equinox Townhome. It's in the New Braunfels, city of New Braunfels. It's in the Austin-San Antonio corridor. Phase 1 of this project was sold out, but we've had a couple investors that backed out because of their stock market losses. So we now have 2 units available again. So this is a beautiful 110 townhome community. It's spread across 10 acres, right in the middle of the city. There's a huge retail center across the street, and the city is building a very modern, beautiful park with amenities right next to us. These are duplexes. They've got vaulted ceilings, large windows, wide rooms. We think they're a dream product for renters and for investor buyers. And you've all heard that build to rent is by far the hottest and growing market in all of real estate. Now combine that with the third fastest growing city in the US in terms of population, and you have New Braunfels. Amazing city, population growth 10 times faster than the US, job growth 9.8 times faster. Amazing, amazing possibilities there. We also have an interest rate cap program, so it allows you to just ignore the interest rates, that could go higher, and simply invest knowing that there's a cap on the interest rates that you will pay, and this unique program is only available through us. So you can also learn more about this project and our new interest rate protection program. You can book a group call with Peggy. The link is on the screen, grocapitus.com, buyer-group-call. We'll see if we can paste that in the chat with you. And now, time for that crystal ball. So let's give you our informed projection on all of these topics. How many times will the Fed hike? What will interest rates be 12 months from now? Will inflation be raging 12 months from now? And will home prices be higher or lower? Will syndicators be paying more or less for multifamily? Will the US economy be in a recession 12 months from now? And finally, what will multifamily cap rates look like in a year? So our projections on a very bumpy ride to come. First forecast on Fed hikes. As of today, the market is robust enough, so we believe that the Fed will actually do what it's been telling us it will do. They will hike the Fed funds rate from 1.5% today to 2.75% by the end of the year. And so it's painful for those of us that have bridge loans with floating rates. I know there are many of you that think that the economy will weaken so quickly that the Fed will not get to that many more hikes. But to those people, I say this: the only thing worse than drinking Kool-Aid is smoking opium. They will go through with the hikes. That's my prediction. They are terrified of hyperinflation, and the Democrats are even more terrified of it because of midterm elections. It's going to happen. Let's start with my mortgage rate forecast. So on the left are single family interest rates or mortgage rates. And this is going to surprise you. The video at the beginning of the presentation said that single family mortgage rates were at 5.6% already. So 6.25% or lower is really gutsy, right? With so many Fed hikes to come? No, not gutsy. Most forecasters would actually agree with me, right? If you look at the blue bars in the chart and you take out this first guy, Adamo, and you take out, the last analyst, Helios, the outliers, the consensus here is actually around 6%. So my number is actually on the bearish side. Also, a year from today, the Fed should be dropping rates, and the mortgage market rate is an early mover. Next up, multifamily interest rates. Much more complicated, by the way. With multifamily, I predict that 10-year fixed mortgage rates will stabilize at around 6% a year from now. Around 6% for multifamily. All right, done with rates, on to home prices. My single family prediction is that prices will not drop nationwide. They will go up by 4% in the next 12 months. But this price hike will not be across the board. I do expect that red hot markets such as Tacoma and Boise will see price drops by 5 to 15%. In fact, I agree with every city on this slide. Redfin and CoreLogic came up with a list of markets that are very likely to see price declines. Luckily, so far, no major cities on this list. Californians, a lot of Entrust IRA folks are Californians. You might want to note that Sacramento is in this list. Washington State has 3 cities in the list. The rest are pretty small. So 4% up nationwide, 5 to 15% drops for cities on this page, plus Boise. That's my single family price forecast for 12 months from now. Let's move over to multifamily and predict cap rates. Now, I know there are people in the audience that don't understand cap rates. So here's a simple example for you. Let's say a property was selling in January in that ultra hot pre-war market at 4 cap for 30 million. Well, if that same property was selling now and closing in October at 4.5 cap, so rate goes up from 4 cap to 4.5 cap, well, its price is going to drop all the way to 26.3 million. So half a cap is a pretty big deal. It can make investors, it can be the difference between investors making 30% a year and making 15% a year. And I'm going to predict that cap rates will rise. I'm going to predict that they will rise by 0.5 cap upwards, which means that prices will drop. Once again, remember this example that I gave you, a $30 million property could go to 26.3 million. All right, so now let's look at our projection of multifamily prices 12 months from now. But wait a minute, Neal, didn't you just show us an example with prices going down from 30 million to 26 million and change? So didn't you already answer the question that's at the top of this page? No, the last slide was an example of how higher cap rates, because of higher interest rates, will affect the price. But there are actually 2 things that affect multifamily price. One is cap rates, the other one is net operating income. Well, let's tweak that example again. On the left was a property selling in January at 4 cap for 30 million. On the right is the same property now selling next year at a higher cap rate of 4.5 cap, but rents are going up like crazy, So if rents go up 10% in the intervening year, this property, even at those higher cap rates because of higher interest rates, sells for almost the same price. So my multifamily price prediction is down, then back up. I expect that when we compare price per unit to Q4 of last year or Q1 of this year, that ultra hot phase, to prices at the end of this year, the post-hike phase, we will find that the price per door is 5 to 10% lower. But as rents continue to rise, we should see the situation reverse. And 12 months from today, I wouldn't be surprised to see multifamily prices go back to where they are. So down a bit, up a bit, but overall flat. All right, the last 2 predictions. I project that the Fed will beat inflation. Look, they've done this 9 times since 1961, and with the exception of 1982, they've beaten inflation every time. And while inflation was at 8.6% in May, that was a 12-month reading. I went to the St. Louis Fed site. I found the month-over-month inflation. It's slowing down. It's moderating. Supply chain issues are also easing. Lumber prices have clashed from about 1,300 to less than half that price today. So we do predict that inflation will be around 3% a year from now. Not quite back to the 2% level that the Fed likes, but well in control. enough for them to stop this gut punching. And we end the webinar by projecting a US recession within the next 12 months. Here, I differ from the analysts. The consensus amongst analysts is that there's only a 40% chance of a recession in the next 12 months. I think that's recency bias. I think that 40% number is going to keep going up as the Fed keeps throwing these rate punches, these liquidity uppercuts. My belief is there's over an 80% chance of a US recession sometime in 2023. Definitely no recession this year. The economy is too strong, household balance sheets too rich, and it does take time to cool everything down. Note, I am not predicting a 2008 timed recession. In the chart above, you see 8 gray bars. 2 of them are thicker, which indicate longer recessions. I believe the recession will be a typical vanilla 6-month recession. It'll be accompanied by the Fed eventually cutting rates and also increasing liquidity, starting this cycle again. So if you can hold on beyond that 2023 recession, you should be able to refinance at lower rates and also see strong demand for real estate assets. And with that positive news about rate cuts, future rate cuts, maybe a year from now, we end this webinar. We would love to take your questions.
Okay, thanks, Neal. Why don't you move on? There's, I think, another screen's going to have our contact info. So this might be a quick Q&A because there aren't a lot of, one more after that. There aren't a lot of questions. So far, the only person that wrote in.
I think this is the last one.
Okay, I thought it had our contact info. So just somebody said.
Yeah, it looks like we missed a slide.
Somebody wrote, missed the price on these new Braunfels. Gordana, you're going to need to reach out to Neal and Grocapitus offline on that. We don't allow them to pricing and things like that on here. As a matter of fact, we're pretty generous with what we do allow Neal to put on, which is more than typical. So go ahead. There's a couple of people you can reach out on for that. I'll give, Neal, we can chat more about offshore real estate investing if we want. Give people a couple more minutes.
Usually takes a couple minutes for
it does,
the questions to come in.
Yeah. I will mention, and I need to find this this podcast, Neal, that you might be interested in, where they talked about. I'm looking on my phone so I can find it, but they talked about the state of the economy, and it's called Plain English with Derek Thompson. Plain English with Derek Thompson. It's a group of podcasts from a site called The Ringer, and they had one back in June 28th. It says 5 reasons everybody is wrong about a U.S. recession, including me. You might be interested in listening to that. I listened to it the other day. I found it. They were looking at some statistics and some things that sort of contradict the idea that we're actually in a recession or going into recession. Some sort of indicators that say that things are actually better than most people think. So for you or anybody else, again, Plain English with Derek Thompson. It's they talk about
I'll check it out.
Things, but yeah, 5 reasons everybody's wrong about a U.S. recession from June 28th. You can get it on Spotify if you have that, or just go to theringer.com and they have their podcasts on there. Okay.
Yeah, I'd like to check it out. I do think that the economy is very strong today, but the challenge is that a lot of people, when they look at the economy, they look at it today. They don't understand that what the Fed is doing affects the economy in the future. So there's no immediate impact apart from, the people that obviously are, buying a house today. It's going to be more expensive 10 days from now if the Fed raises rates today. But I think so much of the impact is in the future. So what I've seen there's this concept of recency bias where people are just looking at the economy today and saying, wow, it's strong. I mean, jobs, you look at unemployment, it's under 4%. Well, the answer is unemployment was around 4% 6 or 7 times before, and then a year later you were in a recession, and unemployment was at 6 or 7 or 8, right? So that's a challenge here. You really have to be looking into the future because it takes a while for these things to apply. Question from Dan, right? I want to answer that. So, are investment opportunities for accredited investors only? Well, the one on the right is what is called a private placement. And yes, those are for accredited investors. The one on the left is just a purchase of a property. Obviously, you don't have to be accredited to buy a property. So it's just a regular vanilla property that you're purchasing. Are these investments UBTI blocked? Well, there is no such thing as UBTI blocked, but I think that you could incur UBTI, and that's a conversation you should have with the people that are on the screen.
Yeah, I mean, using your retirement account, I mean, when UBTI, unrelated, or UDFI, sort of opposite sides of the same coin, is going to sort of come down to how much your IRA. I mean, if you're talking specifically, Nancy, about IRAs, it largely is going to come down to whether Neal, through that transaction, is going to be using leverage, and then how much your IRA might earn from it, and how much leverage was used. So, potentially, if you're investing through an entity like an LLC, and that LLC is borrowing money to help fund that investment that you're making, then yeah, you could potentially be subject to UDFI.
Yep.
Neal, this next one obviously is for you. What are your expectations for syndicated multifamily deals going forward?
Definitely a reduction in profit. So if I had to speculate and say, well, in 2019, Doris invested in 3 syndicated deals, and let's say she made 25% IRR, I would say if you invested with the same 3 guys in deals in 2022, you'd probably be under 20%. So I think that the interest rates hit hard, and while multifamily has performed incredibly in the last 3 years, I expect that to moderate. But I do expect that the overall industry, just let's look at 5,000 syndicators and average it out, should still be double-digit returns. It's just make sure that your expectations are not, the future doesn't look like the present, but the past. However, massive continuing rent increases. May was also an incredible month for rent increases. Mean that the group as a whole should do fairly well. Let's see, Gordana.
There's another one. Yeah, the next one that says, are these? Wait, where was I? Can you please elaborate a little more on the 5 to 10% on multifamily rent bump versus cap rate?
So cap rates are a way of measuring what the value of a multifamily property would be, right? And the way we decide how much to pay for a multifamily property is we take a cap rate that we believe is the market cap rate, and we multiply that by income, by net operating income. Therefore, when interest rates go up, it's common, not always. So from 2015 to 2018, when the Fed raised interest rates 9 times, cap rates did not go up, which means they didn't affect multifamily pricing negatively, but we don't expect that to happen this time because cap rates are lower. So as cap rates go up, prices go down. And so the natural expectation of most people is, well, if you're saying cap rates are going to go up, then that means that, prices are going to go down. And the answer is no, Nelson, because we have incredible rent increases. In the last 60 years, rents have been strongly correlated with inflation. When inflation goes up, rents go up, except when the economy goes into a severe recession like 2008. So that correlation is being maintained at this point. So we do expect that even with cap rates going up, as long as rent increases are strong, multifamily should do well.
Okay, we're out of questions at this point. Wait another. Okay. I'd be interested in a future webinar on offshore investing and how it differs from onshore. You mentioned Costa Rica. What would the graphs from today look like for Costa Rica properties, mortgage trends, rent, et cetera? So we have, if you go back into our history of webinars, and again, we do these monthly. We do have, we've done at least one. We did one a year or 2 ago. Andrew, I'm sure you're there. Maybe delving into offshore real estate investing might be another one we want to do again in the near future. Glenn, I appreciate your feedback, but I do encourage you to go back and maybe Andrew, you could provide Glenn with some direction on the previous offshore real estate investing webinar that we did a year or 2 ago.
Sounds great,
It's
Bill.
a good topic. Yeah, I mean, we've definitely done it.
I think so. I'm just not the right presenter for it.
No,
I would be
yeah.
happy to attend.
I mean, you know, we've got Neal basically every other month at this point, so we may need to give him a break on something. So if multifamily profitability is going down in 23 and we really are in a recession, then isn't it better idea to put your investable dollars into the stock market in 23?
No, I honestly believe that timing the stock market is something that is extremely rare. Most investors, if they looked at what they were doing and how well they actually timed the market, it's very difficult to time it. I believe that multifamily returns are cut in half because of what the Fed is doing, but they're cut in half from a very high basis. And I believe that even cut in half, they're going to do better than the stock market. So today, for example, our properties are doing really well because our cash flow is high, rents are high. But look at the stock market. If you invested in the NASDAQ, I live in the San Francisco Bay Area, you're down 32% in 6 months. If you invested in the S&P 500, which is the larger stock market, you're still down 23%. So I think data does not back what you're saying.
Yeah, and I'm gonna throw out, just from an intro standpoint, we are neutral on what you invest in, right? So if you think the stock market's a better investment than multifamily, then go for it. If you think multifamily is better, then go for it. I mean, but we do encourage anybody who's making investments to talk to advisors and people like that. So, you know, Neal's obviously giving his opinion, and but you know, from an interest standpoint, just, you know, and the fact that this is our webinar, just note that we don't provide that kind of advice, right? So whatever you choose to invest in is a decision you're going to need to make with, you know, whatever research and advice that you seek. But this isn't something
Now,
that, you know, we do our webinars for, is to give any advice or that we provide as a service.
Right. And Bill, I do want to say that something, that even though I don't follow this particular advice, we always advise people that real estate is meant to be a portion of a portfolio. It is never meant to be the portfolio. Yeah. So the best thing to do as an investor is actually to be diversified. The stock market should be a very big chunk of your portfolio. But I think that it's kind of hard to time when you should grow and shrink the stock market portfolio versus the real estate portfolio. That's hard to do.
Yeah, for sure. All right, guys, I think that's it. Neal, appreciate the you know, the timeliness and you reaching out to present this. And for Andrew, what's our next monthly webinar that's coming up? I think next week or the following week.
Mm-hmm. It's July 20th, and it's on the FIRE movement, so financial independence, retire early. And we have a team that retired a couple of years ago that is going to speak on that.
All right. Okay, we did get it. We did get one more quick question we can answer. How do I pull equity out of my home? You want to answer that, Neal?
I think that the standard methodology is obviously to take a home equity loan or a home equity line of credit. I don't like that home equity money being used for investing. I think that you have to be very careful. You have to be extraordinarily confident in your day job. In my opinion, home equity is not the appropriate methodology for investing. So my beliefs being that I will simply say be very careful about pulling home equity out to make investment.
Yeah, and talk to a CPA, talk to an advisor. There's also reverse mortgages. Okay, so we got the cap rate person coming back with one more. With the cap rate swing, would this not be an opportunity long term for multifamily syndication buying, assuming a 3 to 5 year hold? I mean, I think you're preaching the choir on this one from a Neal standpoint.
I think so. I think the answer is yes, but at the same time, you have to be very careful about the fact that today, when you're purchasing, your interest rate is very high. So, Mr. Nelson, I think you were right about the exit, the 3 to 5 year, thing, and the cap rate swing. Yes, it makes sense. But isn't it much harder for you to actually buy anything today, given that you're paying such a high interest rate? I mean, the truth is, we were looking at 150 properties a year and making 150 properties a week, and we were making an offer every 2 weeks. We haven't made an offer in the last 3 months because the interest rates make it very difficult for us to get the same returns for our investors. So that's just a data point. Doesn't mean that we're not making offers. It's just hard to make the numbers work. I do think that things will settle down as the Fed kind of goes through what it's doing. Things will settle down. So my answer is yes, you're right, but I'd probably hold on for a few months and let the market settle.
Okay, let's wrap it up. Thanks, Neal. Thanks everybody for joining.
Thank
Thanks,
you so much.
Andrew. Everybody take care. Have a good day, good weekend.